Hey everybody, I'm Jason. It's Supply and Demand Daily, and I give you the rundown of the. What do I do? Oh yeah, that's right. I keep tabs on the economy, so you don't have to. Today we're going to be talking about unemployment claims in the form of a weekly series that comes out weekly, as I redundantly suggested. We're going to talk about housing construction more specifically, and we're going to talk about the Philadelphia Fed's manufacturing index. So we're going to look at that data and see what manufacturing companies are saying about what the economy looks like. And we're going to do it all in some amount of minutes that I don't know, because I have a tendency to ramble, and when I intend to do something that's going to last about 10 minutes, I sometimes find myself at 30 wondering what the hell actually happened. So I'm going to go ahead and get out of the way, and we will go ahead and get started. It's June 16th. I hope you're having a wonderful Thursday. Initial jobless claims went up by another modicum of a percent. There was about a 3,000 application increase from the 4-week moving average the previous week to the last week, which was literally last week, the week ending Friday, June 9th, I think it was. And so that marks the 10th consecutive increase the 10th consecutive week of increases in the 4-week moving average of initial jobless claims. Now, the more weeks that we add on to these consecutive increases essentially means that the likelihood of going into a labor market downturn, that is the unemployment going up and a systemic loss of jobs, so systemic layoffs all across different sectors of the economy, rises. We've been looking at the different stretches of weeks that we've gone on with increasing 4-week moving averages of unemployment claims, and basically once you get to 10, it really doesn't look pretty. So on this long run chart that I was showing just a second ago, here we go, that doesn't look like a whole lot. I mean, this is what we're talking about right here. This is the 10 consecutive weeks that we mean, and it only looks like a little bit more when you just look at the last year, right? So we came down from 450,000. The U.S. economy was creating that many jobs not too many months ago, and then so here we just see this really gradual uptick. But with unemployment claims, you'll notice that that's usually how it goes. It doesn't usually have this very pronounced effect until you're well into the recessionary part of the business cycle. But that's where we are. By the way, these shaded areas designate U.S. recessions. So that's what I'm showing here, is that every time we have one of these downturns in the economy in general, we start to have a gradual increase in the 4-week moving average of unemployment claims. Now, when you look at the reporting on this particular indicator, often it's just it went up this week, went down this week. There's not really much talk about the longer trend, even if that longer trend is only a few months. But it's important to look at that because there's a lot of noise in this particular data set, and so that's why I prefer to look at the 4-week moving average. It's publicly available on the Federal Reserve Bank of St. Louis's website, but you don't have to go and download it because you have me and you are subscribed to my YouTube channel, hopefully, or subscribe to my TikTok or whatever. So that is the situation in the labor market that we got today. Moving on, bond yields. I didn't mention that I was going to talk about that, but I just wanted to cover this really quick. So I predicted that the 10-year Treasury yield, that is the yield on the 10-year bond, the 10-year U.S. government bond, would only go up to 3.18%, and I was decisively proven wrong by the bond market when we got a huge unexpected print in the rate of CPI inflation as of May 2022 of 8.6%, and then that sent these bond yields going way, way up. So what I'm showing here is the dark blue line. That's the one that I was just talking about. That would be the 10-year government bond yield, and then the orange line would be the 5-year, and the light blue line would be the 2-year. Sorry if you are colorblind or sensitive for that shading there, which probably does not help you very much. If you would like me to change my color scheme in order to accommodate, please let me know. I will do whatever I can. And so yeah, that's the situation with bond yields. They went surging after this really big CPI print, and then they came right back down in the last couple of days after spending a couple more days above that 3.18% marker that I pointed out incorrectly when I predicted that would be the ultimate cap in this cycle in the yield on that particular type of bond. Moving on, the Philly Fed, that is the Philadelphia Federal Reserve Bank. There are 12 of them, and they all do their own little types of research that is very useful to look at when you're studying the economy. So anyway, this is the General Activity Index for manufacturers in the Philadelphia region, the Philadelphia Federal Reserve region, which, like I said, encompasses some, not all, of the Rust Belt. As you can see, this is a 5-year chart going back to January of 2017, and for the first time ever since the 2020 recession, that was a very sudden recession brought into effect by lockdowns, we are down back below zero, which was anticipated given the reading last month when we got the data for May, and as of June, this level is now below zero, and the expected rate of increase in manufacturing output, or the expected general activity index, that is what is denoted by this orange line. That is an expectation of future business activity on the part of these manufacturing firms, has definitely dipped below the index of current activity, which means that these manufacturers are expecting business conditions slightly down the road in the future, let's say 6 months, to be worse than they are now. Although not that much at this particular juncture, but this indicator is decidedly in recessionary territory. And another detail from this particular survey that I've been looking at and that I have shared in previous videos, coming from other manufacturing surveys, is the index of manufacturers who are reporting that they're paying higher prices for their inputs. All right, and then so that's what I have in the blue line, and then the orange line is the index of manufacturers who are reporting an increase in prices of what they sell. So, and in other words, this is an increase in the prices that they charge, whereas the blue line is an increase in the prices that they get charged for the stuff that they have to use in order to make the stuff that they sell. Input prices in the blue and output prices in the orange. Both of them are extremely elevated, right? So both of these indicators are extremely elevated relative to history. Even in this past expansion, which kind of peaked and went down in 2018, we had an increase in input prices that was not anywhere near as high as it is now. Now, the way that I said that may be a little bit deceiving. What we're looking at is not a rate of change in input prices. This is an index of manufacturers who are reporting that their input price is going up. So the bigger this number is, essentially that means the greater the share of manufacturers who are reporting that their input prices are increasing versus decreasing. All right, so that's what we have going on there. And the other thing that I want to point out here is that there is always, like systemically, a higher share of manufacturers reporting that their input prices are going up than reporting that their output prices are going up. And you usually see a higher increase in producer prices than you see in consumer prices. So while this may be counterintuitive, and there tends to be an idea in everyday conversation that employers and that producers of goods basically just charge whatever the hell they want to, and don't really care what the consumer has to pay. They are quite severely limited by the boundaries of what the consumer wants to spend, and that's why you get charts like this. So there is a little bit of filtration that goes from higher producer prices into higher consumer prices. In a sense, the consumer is sheltered, is protected from all of not having all of the increase in producer prices passed down to them. So a lot of times manufacturers end up eating a lot of this extra cost. Just something to keep in mind next time you pay a higher price for a bag of potato chips and get really mad about it. And virtually everything's going up. I'm not saying that inflation doesn't suck. It absolutely does. It sucks. What I'm saying is that the manufacturers of the goods experience it usually more than the consumer does. in a lot of cases. So, especially among small businesses and especially, mid-sized businesses as well. Just one more note from the Philly Fed Manufacturing Index. The types of issues that they were reporting were weighing the heaviest on their activities are a current lack of labor supply. So we had 39.5% of respondents in this survey reporting that this was a significant issue, keeping them from operating at full capacity. And we had 41.9% reporting, that it was a significant, that supply chains, that the mismatches and the problems and the logistical issues along the supply chains that it takes to get their inputs to them so that they can turn them into other stuff to sell to me and you, is 41.9%. So we had 41.9% of respondents saying that supply chains were a major issue. Basically, these two indicators or these two questions, as far as their responses go, are neck and neck. We have 39.5% and 41.9%. And what that tells me is that the supply chain issues that we've seen, thank you, China, for shutting down, most of your major port cities and, trying to limit your energy uses. Fight COVID, cover that in a different video maybe. But, thank you very much for making sure that the supply chain issues are not going to be resolved completely anytime soon, or at least return back to a normal 2019 sort of level. So that is about all that we saw in the Philly Fed Manufacturing Index. We're going to touch briefly on housing construction now. Single-family construction is a really important indicator if you like having a roof over your head. I know I do, and I know you probably do too, if you are most people. So the thing that I wanted to point out is, first of all, this is a seasonally adjusted annual rate. These two lines here that we're looking at, they're seasonally adjusted annual rates. What does that mean? It simply means that if you take the monthly number of housing projects started, so let's take this blue line, which is single-family housing projects began. Actually, no, that's false. Let's look at the blue line. The blue line is single-family housing projects completed. I could have sworn that I labeled this chart, but I guess I did not. So blue line is completions, orange line is starts. Try to keep that in mind. So the blue line is completions. What we're looking at is not the number of single-family housing projects that were completed in that particular month, but it is a seasonally adjusted annual rate. So it's like if you took that month and then you adjusted it to the seasonality of home building. A lot gets done in the summer, not very much gets done in the winter. That's what I mean by seasonality. And you multiplied it by 12, then that would give you, the simulated number that you would get in a year, the simulated output of housing completions that you would get in a year. So if you were reading this chart and we saw this this number, 1,500, this is in thousands, so we're talking 1.5 million in May of 2007 approximately, or maybe March of 2007, right? That would be a yearly rate, an annual rate of 1.5 million houses completed. Now, one thing that I want to point out, and the thing that I like to look at with this housing construction cycle, is that you have this push and pull between, or maybe this tension, kind of this dance between the completions of housing and the starts of housing projects, the starts of construction projects. And in the expansion phase of a housing market cycle, you tend to get more starts than you do completions. So let's say that there are maybe for every one housing project start, for every one single family home that is started, you might get maybe 0.95 or 9/10 of a house being completed, right? That's the idea that I'm talking about here. And then in a relatively normal time frame, in a relatively normal market, you kind of see the two follow each other and dance around each other up and down. When you get into the expansion phase of a housing cycle, again, everybody wants to buy houses, and the home builders builders start to really invest in building new houses because their prices are going up. And so what that means is that you end up getting more housing starts by a larger margin than you do housing completions. And I'm going to show you a chart in just a second that only shows that. But the thing that I want to point out is that when basically the bear market or the downtrend in housing started in 2006, that's when completions actually overtook starts because the home building industry lost investment and obviously was anticipating prices going down and anticipating less demand because the demand was dropping, and so they stopped building, they stopped starting new projects, and then essentially that allowed completions to start to catch up with it, and then these older projects that were sort of in the backlog, those got completed, and then completions follow starts all the way down until the market finds some kind of bottom, and this was the conclusion of the bear market in housing between 2010, 2011 on into 2012 when we started to see a recovery in construction activity. Now, one way that you can sort of measure the bubbliness or the froth or the amount of surging demand in the housing market, the amount of surging investment into this sector is just how many more starts there are than completions, right? So what does that mean? What does that look like for 2020 through 2021 and the earlier part of 2022? Well, it looks like this. So this was the previous housing bubble in the early 2000s that contributed to the meltdown in the financial sector that wound up, causing the Great Recession of 2009, 2010, and so on, with a very slow recovery that most of us probably remember personally. If you don't, not a fun time. But so that's what I'm showing here. This is just the number of starts minus the number of completions. So we've taken the relationship between these two lines and we turned it into one line, essentially. All right, so that's what I'm showing here. And then the completions, like I said, they'll overtake the starts. That's what happens in the housing bear market. And then we had a relatively normal sort of era in the mid-20 teens, right? In the mid-20 teens, we had this normal fluctuation. Starts are a little bit higher than completions. I guess maybe not every single house gets completed. I'm not sure. I've never been a home builder. And then boom, we come to 2020 and we surge in the crazy upward direction, further, a bigger gap than we've ever seen before in the history of this series. This series goes back to 1968, and I checked, it was a greater surge. I'm not just talking about the last 22 years, but this was crazy. And how exactly crazy was it? Well, essentially, the number of starts in this month here, which I believe was, December of 2020, the number of starts in this month here was 40% higher than the number of completions. Again, a record-breaking level. And if you take the average, it was definitely also a lot higher than the average in the housing bubble in the early 2000s. So why is that? Well, you have a combination of two factors: a crap ton of liquidity being dumped into the housing market through a lot of it through Federal Reserve purchases of mortgage bonds, which is how most of the housing market gets its money, how most of the housing market is ultimately financed. And you have these huge supply chain issues where, lumber mills actually get shut down. People are kept from going to work in the factories that produce laundry machines and sinks and dishwashers and ovens and all of the kinds of fixtures that you need in order to fit out a door, and all the framing that it requires to build a house, and the brackets that make the brackets that make up the posts and beams that support a roof, and all of these different things. Post and beams is not correct terminology, so if you're a carpenter, don't sue me, but you know what I mean. The joists or something, I'm not sure. Again, I've never been a home builder, so tell me in the comments if you would like how that actually works. But now we've seen this gap completely close, right? So there's no longer much investment going into the single-family residential sector. This particular cycle looks like it's coming to a conclusion, and what we will probably see in the coming months is we will see completions override starts. And what that means is that supply of housing is about to actually open up, which is a good thing, except for people who are going to want to sell their homes in the next few years. They might have to end up, depending on what kind of effect this has on prices, they might have to end up taking a lower price than they otherwise would. But, economically, more supply is always good. It's always good to have more supply. So, because we want places to live. Again, we're humans. We like roof over our heads. That's how it works. So, supply is about to open up as completions overtake starts and investment starts to pull out of the home building sector. They will complete as many homes as they can, and then we will see a resurgence at some point, whenever the housing cycle starts back up again. Hard to know exactly when that's going to be. Now, what am I going to talk about tomorrow? We're going to get the index of industrial production numbers, which I think is an incredibly important indicator, and a lot of people think is an incredibly important indicator. Industrial production is one of the reasons that I do not believe that a real recession in terms of actual output has really gotten its legs yet. A lot of people are saying that the recession has already started because there was a negative print in real gross domestic product for the first quarter. That would be the quarter ending March 31st of 2022. But usually in most previous recessions, there's been a decrease in both real GDP and industrial production and a decrease in employment at the same time. What we're seeing right now is that there was a decrease in real GDP, mostly because the dollars that go into the gross domestic product spending have been highly inflated. So the value of them in terms of goods has dropped. But industrial production, at least as far as recently as April of this year, was still increasing. So that's basically one of the only couple reasons that I think that the economic downturn has not arrived in full form. So I'm very interested to see. It has, by the way, in China, and it has in Germany and a lot of different countries around the world, just not yet the United States. So I'm very interested to see how that all shakes out tomorrow. So I hope you'll join me for that. That'll be June 17th, 2022, Friday. And I hope you enjoy the rest of your Thursday evening. It's been a pleasure talking to you, and I hope to see you back tomorrow. Thank you very much, and have a great day.